Good morning and welcome to Charting the Markets on Monday, the 2nd of October. Legislators in the US managed to avoid a government shutdown at the very last minute and pushed back the date of this happening, potentially happening, by 45 days to the middle of November. Now, that led to risk-on sentiment at the beginning of the Asian session this morning, and we could see that on the daily financial bet chart of the Nikkei 225 here in Japan. We had a rally of 1.7% take us to the orange line here, the 55-day simple moving average at 32,415. But then the negative sentiment that we saw for much of September resumed. And as you can see here, we completely failed and headed back down again, actually, towards last week's low, the September low, 31,665.4. Now, judging by the current picture here from a technical perspective, at least, since we have a series of lower highs and lower lows, the odds are very high that we will actually fall through that level. And if so, we could then head back down again towards the August low at 31,251.2 on this daily financial bet. So provided we stay below today's intraday high in Japan at 32,410.8, further downside looks to be in store for this index. And in the United Kingdom, we've had outperformance by the FTSE 100 in the month of September, simply because the oil price and energy prices rose very strongly, and also mining stocks, and all of that helped the FTSE 100 basically to not decline as much as other US and European indices in the month of September. But here what we can see also is last week we tried to overcome the 200-day simply moving average here in red at 7,650. And earlier this morning, we again tried to hit that, but failed and are coming off again. So the FTSE 100 looks to be heading back down again towards its August to October uptrend line at 7,542. And below there, we have some pretty good support between the orange line here, the 55-day simple moving average, and last week's low between 7,531 and 7,523. So these are sort of the lines in the sand, if you want. As long as we stay above there, we could potentially see a reversal. But if we were to fall through these levels, then we could actually also in October start off the month on a bad footing and perhaps head back down again towards the September low at 7,369. Now, for the bulls to be in control and to avert such a sell-off, what we need to see is a rise and daily chart close above Friday's high at 7,675 on the FTSE 100. If that were to happen, it looks more likely that the recent uptrend we've seen since the late August lows could actually continue. And in Germany, the picture is quite similar. You can see here we've bounced off the low seen last week in September at 15,137, but haven't really managed to test the red line here, the 200-day simply moving average, 15,618. And you can see that it is marginally above the July, August, and mid-September lows between 15,455 and 15,561. And basically, we need to take out all of these levels and also close above the red line, the 200-day simply moving average at 15,619, for us to have more confidence in saying that perhaps we are bottoming out here and we are reversing to the upside. Unless that happens, there is the chance of us retesting this low, maybe falling through it very briefly towards the 15,000 mark or so, and then perhaps recovering. Because usually, historically speaking, if you go back for several decades, the month of October, in a period where we had years where the markets rallied between January and the middle of the year, if that was positive, that period, then normally the month of October tends to be a positive one as well, with an average rise in the US of about 8%. So perhaps this quarter could be a good one, but we'll have to see. Right now, markets are still quite cautious. And in the US, if you look at that, yes, markets are also cautious. As you can see here, we bounced off last week's low at 4,239, managed to rise on Friday to 4,332 on the daily financial bet of the S&P 500, but in the overnight session so far are trading just slightly higher above Friday's close. But also quite cautiously ahead of Jerome Powell's speech later on today at 4 p.m. We also have other Fed members speaking later on this afternoon, and also in the United Kingdom, a monetary policy member who is called Mr. Mann, who's also speaking later on. So we'll have to see what happens here with regards to the US markets. If we were to fall through last week's low on the S&P 500 below 4,239, then we have some really, really good support here. Yet that you can see going back to the beginning of May of this year, and also where the 200-day simple moving average here in red comes in. And this comes in between 4,214 and 4,187. So that is the key support area for me from a technical perspective. But for the bulls to basically gain traction with regards to pushing the market higher, what we need to see is a rise above 4,332. That's to say Friday's high. Unless that happens, the downside looks to be more probable still. Last week, the US dollar rallied for its 11th consecutive week, something that we haven't seen for decades. And if you look at the US dollar basket, you can see here that we remain in a very clearly defined upward trending channel. And last week we hit 106.49 before consolidating. As you can see, this week is starting off quite positive as well, ahead of Jerome Powell's speech later on today at 4 p.m. UK time. And basically from a technical perspective, provided we stay above the last reaction low, that's to say Friday's low, here on the US dollar basket at 105.29, further upside looks to be more likely than any possible reversal to the downside. So if we were to rise above 106.49, I would have to zoom out to basically here the late November high at 106.87, which would be the next upside target for the US dollar basket. And then above there, you've got the September low from last year, and together with the 21st of November high. And these come in between 107.50 or so and 107.63. So that would be the next upside target. But as you can see here, the trend is your friend. And for the US dollar basket, it is still pointing higher despite 11 consecutive weeks of gains for the greenback. And the inverse of that, as you can see here, is the euro dollar. The euro makes up 57.6% of the US dollar basket. And you can see here we have this downtrend in place since mid-July. Now we bounced back on Friday and managed to rise to 106.17. But whilst we stay below that high, it is possible that we might actually fall back to last week's low at 104.88. And that is part of this key support area between 104.84 and 104.44, which is made up of the late November highs and also the January low of this year. So that is a distinct possibility as this downtrend continues for the time being with regards to the euro dollar. And cable is quite similar. You can see here the British pound against the US dollar also sliding. Now here what we saw is a retest of the upper downtrend channel resistance line, but that capped on Friday at 122.71. And basically, whilst we stay below there, further downside looks to be likely to be seen if we fall through last week's low, 121.11. The next downside target would be the psychological 120 area. And if you look at Japan, what is interesting there is that earlier this morning we had some data out, and basically business sentiment for the third quarter rose the highest in the past 5 quarters. But despite that, the US dollar continued to appreciate versus the Japanese yen, and we so far have risen to 149 yen and 89 sen. Actually, I need to correct this one here. We've risen to a new high and are now approaching the psychological 150 mark. Now, around the 150 area, I wouldn't be surprised because it's a round number, not psychological number, if the Bank of Japan were to start to talk about perhaps intervening with regards to its currency. Because if you go back to last year, this is a weekly chart here, you can see that back in October of last year, we topped out at 151.94, and then we had a very sharp reversal to the downside, and that was kicked off by intervention by the Bank of Japan. So could we see it again? It is a distinct possibility, but for the time being, traders seem to want to push the US dollar higher versus the Japanese yen. And from a technical perspective, provided we stay above the last reaction low, that's to say Friday's low, here at 148.53, the uptrend remains intact. The stronger dollar over the last 11, I should say, consecutive weeks has a very negative impact on the price of gold and silver, which have both been declining very sharply over the last few days, especially last week. But before I talk about these two precious metals, what I would like to do is to have a look at the price of gold. And you can see here, US crude, that is to say WTI, rallied to $94.25 per barrel last week, but then interestingly enough started to come off slightly and slid back down towards the psychological $90 mark. And for technical analysts, this didn't really come as a surprise, because as we could see here, and as we pointed out last week, we had negative divergence. And that happens when you have a higher high on the price chart compared to a previous high. So you can see here at $94.25, last week's high was higher than the one at $92.38 in the previous week. But if you look at the bottom of this chart, you can see the relative strength index, the RSI, making a lower high. When that happens, it is called negative divergence, and it points in about 70% of cases or so in most markets to at least a short-term reversal or correction in the previous trend being seen. And since we've seen an uptrend with regards to the price of crude oil, you can see that since mid-August, actually since July, we've risen by about 16%. No, actually, we've risen about 33% since mid-July and about 16% since the end of August. It isn't surprising to see at least a short-term consolidation. Now, this is just a short-term consolidation for the time being, because you can see here we've actually bounced off the August to October uptrend line just today, and we're holding there. But what we need to look out for is the last reaction low, a low which was made below the candles to its left and to its right, and that was made on the 26th of September at $87.85. Now, if we were, and this is a big if, but if we were to fall through $87.85 on a daily chart closing basis, it would indicate that from a technical perspective, at least, we formed a minor top. And in that case, we could actually slip back down again towards the August high at $84.39. But this hasn't happened yet. Right now, we're just consolidating below these highs. We made the near one-year highs at $94.25 last week. Now, as I said, the gold price has been coming off very sharply. And as you can see that here, since last week, I mean, we've actually had 6 consecutive days of lower prices with regards to the price of gold. And right now we're trading around $1,835 per troy ounce. And that takes us back to levels last seen in March of this year. And we now have as a potential downside target the February and March lows of last year, which come in between $1,809 and $1,805. And you can clearly see that we have had an acceleration to the downside. We tried to rally, on Friday very briefly, but we didn't manage to do so and then reversed lower. And right now, we really are targeting this $1,809 to $1,805 per troy ounce with regards to the price of gold. And the silver price is also quite interesting in that here we also try to bounce back. I'll just zoom in onto this daily financial bet, and you can see here that the bounce took us not just above the August to September downtrend line, but also intraday on Friday above the 200 and the 55-day simple moving averages. Well, actually, no, the 55-day simple moving average at $23.51 capped the upside. And then we reversed back down again. And then we closed below the previous day's low. And that is really negative, because you've got the bulls pushing the metal here higher. But then on the daily chart closing basis, we close below the previous day's close and also below the weekly close, and we closed right on this key support area going back to June of this year at $22.12. But what we've seen since is a fall through this key support area, which is this whole area between the June and mid-September lows. And that to me says that further downside is most likely to be seen, and it could take us back down again to the 6th of March high at $21.31. And then below there, we've got the psychological $20 mark as a potential downside target, together with the March low at $19.90. But the trend's your friend. It's pointing lower. And if we were to see a reversal to the upside, we've got some pretty good resistance now, basically between the May to September lows, between $22.12 and $22.68. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter, and my handle is @AxelR_IG.